Welcome to My Business Success. If you've been thinking about investing but have no idea where to start, this video is for you. Today, I'm going to share the top investment tips for beginners in 2024. Whether you're looking to grow your wealth or just want to make your money work for you, investing is the key to building financial security and freedom. So, why should you start investing in 2024? Well, inflation is constantly eroding the value of your savings, and the earlier you start, the more time your money has to grow through the power of compounding. Investing allows your money to generate more money. So even if you start with a small amount, you can grow it into something significant over time. And in this video, we'll go over the basics of investing, how to choose your first investments, and strategies to build long-term wealth. Let's dive in. Now that we've talked about why you should start investing, let's dive into the basics. Understanding the fundamentals is crucial, especially if you're new to this world. First, let's define what investing really means. When you invest, you're putting your money into something with the expectation that it will grow over time. This could be stocks, bonds, real estate, or even businesses. Unlike saving, where you're keeping your money in a low-risk account, investing involves taking some level of risk for potentially higher rewards. Next, we have to talk about risk and return. Every investment comes with a level of risk. Whether it's low risk or high risk, it's important to understand that. In general, the higher the potential return, the higher the risk. For beginners, it's best to start with safer, more stable investments like index funds or ETFs. These allow you to invest in a broad market instead of putting all your money into one company. Another key concept is diversification. You've probably heard the phrase, don't put all your eggs in one basket. That's what diversification is all about. By spreading your investments across different asset types like stocks, bonds, and real estate, you reduce the risk of losing everything if one investment goes bad. This helps balance your portfolio and gives you more stability over time. Finally, there's compounding. This is what makes investing so powerful. Compounding is when your investments earn returns, and those returns generate even more returns. It's like a snowball effect. The earlier you start, the more your money can grow exponentially over time. In the next chapter, we'll talk about how to set clear financial goals and align them with your investment strategy. But first, remember, investing isn't about getting rich overnight. It's about building wealth steadily and responsibly. Setting clear financial goals is a crucial step before diving into the world of investing. Without a clear destination in mind, it's difficult to map out a solid investment strategy. Start by defining what you want to achieve. And are you saving for retirement, buying a home, starting a business, or building an emergency fund? Each of these goals will influence how much you need to invest, which investments are suitable, and how long you'll need to stay invested. Goals can typically be categorized into short-term, mid-term, and long-term. Short-term goals, 3 years, could include saving for a vacation or creating an emergency fund. For these, prioritize low-risk investments like high-yield savings accounts or short-term bonds. Mid-term goals, 3 to 5 years, such as saving for a down payment on a house, may require a balanced approach with both safe investments and slightly higher risk options like bonds and low-risk stocks or ETFs. Long-term goals, 5+ years, like retirement or saving for a child's education, allow you to take on more risk with investments such as stocks, ETFs, or real estate, since there's more time to recover from market fluctuations. Once you've outlined your goals, ensure that your investment strategy aligns with them. The key is to match your investment horizon with the appropriate level of risk. Long-term goals can tolerate more risk, while short-term goals should focus on stability and liquidity. As your financial situation changes, it's important to regularly review and adjust your goals and investment strategy. With your financial goals in place, it's important to understand the types of investments that suit beginners. The investment landscape can be overwhelming, but there are several options that are perfect for those just starting out. Exchange-traded funds, ETFs, are one of the simplest and safest ways to invest as a beginner. They allow you to invest in a basket of stocks or bonds, providing diversification and reducing risk. For instance, an ETF that tracks the stock market offers broad exposure. Additionally, ETFs typically have lower fees than mutual funds, making them a cost-effective choice. Index funds are another good option for beginners. These funds track specific market indices like the S&P 500. They are ideal for long-term passive investing and offer diversification, making them great for building wealth steadily over time. For those seeking safer options, bonds might be the way to go. Bonds are loans you give to companies or governments in exchange for interest payments over time. They carry lower risk but offer lower returns, making them a good choice for balancing your portfolio with more stable investments. If you prefer a hands-off approach, robo-advisors are a great choice. These platforms use algorithms to create and manage a diversified investment portfolio based on your financial goals and risk tolerance. Robo-advisors are excellent for beginners who want to invest without having to make all the decisions themselves. For those interested in real estate, but without the capital to buy property, REITs, real estate investment trusts, are a good alternative. REITs allow you to invest in real estate projects without owning property directly, giving you exposure to the real estate market while maintaining liquidity. These investment options are a great starting point for beginners. As you gain more experience, you can diversify into other areas. In the next chapter, we'll explore long-term investment strategies that help you stay consistent and grow your wealth steadily. Building long-term wealth requires patience, discipline, and a solid investment strategy. It's easy to get caught up in short-term market trends, but successful investors focus on strategies that deliver consistent growth over time. One of the most powerful long-term strategies is buy and hold investing. This approach involves purchasing investments such as stocks or ETFs and holding on to them for years, even decades. The idea is to benefit from the natural growth of the market, taking advantage of compounding returns over time. This strategy allows you to ride out market volatility without reacting emotionally to short-term market dips. Another important strategy is dollar cost averaging. Instead of trying to time the market, this strategy involves investing a fixed amount of money at regular intervals, regardless of the market's performance. By investing consistently, you reduce the risk of buying at the wrong time and smooth out the cost of your investments over time. Diversification also plays a key role in long-term success. By spreading your investments across different asset classes, such as stocks, bonds, and real estate, you reduce the risk of significant losses if one sector underperforms. A diversified portfolio helps balance risk and reward, providing more stability over time. It's also crucial to reinvest dividends. When you invest in dividend-paying stocks or funds, reinvesting those dividends back into your investments can accelerate your growth. This is another way to take advantage of compounding, allowing your money to work for you over the long haul. Lastly, avoid the temptation of market timing. Trying to predict the best times to buy or sell investments often leads to missed opportunities. Instead, stay focused on your long-term goals and stick to your investment plan, no matter how the market is behaving in the short term. Long-term investing is about patience and discipline. By sticking with these strategies, you'll give your money the time it needs to grow and achieve your financial goals. In the next chapter, we'll look at how to avoid common investment mistakes that beginners often make. As a beginner, it's easy to make mistakes when you first start investing. The key to long-term success is recognizing these pitfalls early and knowing how to avoid them. One of the biggest mistakes is trying to time the market. Many beginners believe they can predict the best times to buy or sell. The truth is, even experienced investors struggle with this. Instead of trying to time the market, stick to a strategy like dollar cost averaging or buy and hold. This helps you stay invested and avoid missing out on potential gains. Another common mistake is putting all your money in one investment. Whether it's a single stock or even just one type of asset, concentrating your money in one place increases increases your risk. Diversification is essential to reduce risk and protect your portfolio from significant losses. Spread your investments across various asset classes like stocks, bonds, and real estate. Emotional investing is another trap. The market will go up and down, and it's easy to panic when you see your portfolio lose value. But selling in a panic locks in losses. Instead, focus on your long-term goals and remember that market downturns are temporary. Stay calm, avoid reacting to short-term volatility, and give your investments time to recover. Beginners often overlook the impact of fees and expenses. Every investment comes with costs, whether it's brokerage fees, management fees for mutual funds, or expense ratios for ETFs. Over time, high fees can eat into your returns. Pay attention to the fees associated with your investments and choose low-cost options when possible. Finally, avoid constantly checking your investments. It's tempting to check your portfolio every day, but this can lead to unnecessary stress and short-term thinking. Successful investing is about staying the course and focusing on the long term. Checking too often might cause you to make impulsive decisions that can hurt your returns. By avoiding these common mistakes and staying disciplined, you'll increase your chances of long-term success. In the next chapter, we'll wrap up with final tips and advice to keep you on track as you begin your investing journey. As we wrap up this video, let's go over some final tips to help you stay on track with your investment journey. Whether you're just starting out or have already begun investing, these pointers will keep you focused and motivated. First, remember that patience is key. Building wealth through investing takes time. The stock market will have ups and downs, but it's important to keep a long-term perspective. Don't get discouraged by short-term volatility and avoid making impulsive decisions when the market dips. Stay consistent with your contributions. Regularly investing small amounts can lead to significant growth over time. Whether you're using a strategy like dollar cost averaging or contributing to your retirement account monthly, consistency is the secret to compounding your wealth. Make it a habit to review your portfolio regularly. While you shouldn't check it daily, an annual or biannual review will help you assess if your investments are aligned with your goals. Adjust your portfolio as needed to ensure it remains balanced and diversified. Continue to educate yourself. And the world of investing is constantly changing, and staying informed is crucial to making smart decisions. Read books, listen to podcasts, or follow reliable financial blogs to keep learning and refining your strategies. Lastly, stick to your plan. Having a well thought out investment strategy will keep you grounded when markets are volatile. Trust the process and don't let short-term noise derail your long-term goals. Thank you for watching this video. I hope these tips have given you a clear path to start your investment journey confidently. If you found this video helpful, please subscribe, like, and leave a comment with any questions. I look forward to seeing you succeed in your financial journey. Good luck and stay consistent. As we've discussed throughout this video, the most important thing is to take action. You don't need to have a large amount of money or be an expert to start investing. The key is simply to get started. If you're new to investing, consider beginning with something simple like an ETF or index fund. These investments provide diversification and are a great way to get your feet wet without needing to analyze individual stocks. Set up automatic contributions if you can. Automating your investments ensures that you're consistently building your portfolio without the stress of remembering to make each individual investment. It's one of the best ways to build long-term wealth without overthinking it. Start small if you need to. Even investing a small amount regularly can grow significantly over time thanks to the power of compounding. The earlier you start, the more time your money has to grow. Remember, every investment journey starts with that first step. Don't wait for the perfect time because there's no such thing. The most successful investors are those who start early and stay consistent, no matter the market conditions. To sum up, here's your action plan. Choose an investment type that matches your goals. Automate your contributions, stay patient and consistent. By following these steps, you'll be well on your way to building a solid financial future. Thank you for watching, and I wish you the best on your investing journey. If you have any questions, leave a comment below. Don't forget to subscribe and share this video with others who are just starting out. Let's grow together.